Welcome, everyone. Today I'll be talking about part 4 of the Credit and Debt Management Workbook series. Today's topic is on credit reports and credit scores. I want to mention that understanding credit isn't just about numbers, it's about opportunities. For many people struggling with poverty, good credit can mean access to better housing, jobs, and financial freedom. In this presentation, we will explore how we can build strong credit and use it as a tool for empowerment.
In this presentation, I'll be talking about understanding credit reports, what is included in a credit report, and then I'll talk about the explanation of credit scores and the factors that are used in calculating your credit score. Then I'll talk about who uses your credit information, followed by the impact of poor credit. After that, I'll be talking about how you can improve your credit score and how you can build a strong credit history. Then, I'll conclude the presentation with the key takeaways. Now let's take a look at understanding credit reports. A credit report is more than just a financial record, it's your financial reputation. If you ever struggle with money, you know how hard it is to get approved for a loan or renting an apartment. But with the right steps, you can take control of your credit and open new doors to financial stability. Let's take a look at the definition of a credit report. A credit report is basically a detailed record of your credit history, including debts, payments, and financial activities. But why is a credit report even important? It's important because lenders, employers, landlords, and insurers use them to assess your financial responsibility. Now I'm going to talk about what is included in a credit report. Your credit report basically tells a story, one that your lenders, landlords, and even employers read before making decisions. The first component of a credit report includes your personal details, such as your name, address, and your job information. The second component includes your credit accounts, payment history, and your banking details. The third component of a credit report includes any public records that you may have, including bankruptcies, loans, and judgments. The fourth component of a credit report includes any collection actions and any credit inquiries. For those in financial hardship, knowing what's going on in your credit report can help you fix errors, manage your debts, and start building a stronger financial future. Now I'm going to talk about an explanation of credit scores. Your credit score is like a grade for your financial responsibility. The higher your score, the more likely you are to get approved for loans, apartments, and even jobs. But here's the key. Building good credit isn't just for the wealthy. With the right habits, anyone can improve their credit score and unlock better financial opportunities. The lowest possible credit score in Canada is 300, and the highest possible credit score is 900. And a key tip to keep in mind is to keep your credit card balances below 35% of your credit limit. Also keep in mind that your credit score is a numerical representation of your credit worthiness. This also means that higher scores can mean lower risk for lenders. Now I'm going to talk about how credit scores are calculated. There are 5 main factors that determine your credit score. The first one being payment history, and this accounts for 35% of the overall credit score. These are the on-time payments that boost your score, while late or missed payments can lower it. The second factor is credit utilization, which accounts for 30% of your overall credit score. This is the percentage of your available credit that you use. Keep in mind that a lower utilization, like below 30%, is better. The third factor is the length of your credit history, and this accounts for 15% of your credit score. The longer the credit history that you have, the better it will improve your credit score, as it shows a track record of your responsible credit use. The fourth factor is credit mix, which accounts for 10% of your credit score. This means having a variety of credit types, such as credit cards, loans, and mortgages, can positively impact your score. The final factor is new credit inquiries, and this accounts for 10% of your credit score. Too many hard inquiries from applying for credit in a short period can lower your credit score. Keep in mind that lenders use your credit score to assess your credit worthiness when it comes to approving loans or credit cards. Now I'm going to talk about who uses your credit information. Think that your credit score only matters for loans? Think again. Banks, landlords, employers, and even insurance companies use your credit information to make decisions. For example, lenders such as banks and credit card companies check your credit score before approving loans or setting interest rates. Landlords also review your credit to determine if you're likely to pay rent on time. Employers also require credit checks, especially for financial positions. Insurance companies may also use credit information to set premium rates. That's why maintaining a good credit score isn't just about borrowing, it's also about having access to better opportunities in life. Now I'm going to talk about the impact of poor credit. A low credit score can feel like a trap, as it can lead to loan rejections, high interest rates, and difficulty finding housing or even jobs. But breaking free from this cycle is possible. Understanding the impact of poor credit is the first step in making changes that will lead to financial stability and freedom. Now I'm going to talk about how you can improve your credit score. Good news, you can fix your credit, and this can be done in multiple ways. The first way being paying your bills on time. This means making the minimum payments by the due dates and considering setting up automated payments. The second way is to manage your credit utilization. This means keeping your balances below 35% of your credit limit. The third way is to limit your credit applications that can lower your credit score. Last but not least, remember to pay down your debt, which means reducing any existing debts as quickly as possible. Now I'm going to talk about how you can build a solid credit history. For those who have never had credit before or need a fresh start, building credit wisely is key. Start small with a secured credit card and pay it off each month and watch your credit score grow. A strong credit history can be a game changer, especially for those trying to break the cycle of poverty. Now let's take a look at the key takeaways. The first takeaway is to check your credit report at least once a year. It's also important to have responsible habits, which means paying on time, keeping your balances low, and limiting new credit applications. It's also important to look at the long-term view, which means building good credit takes time, but it opens doors to better financial opportunities. Lastly, it's also important to correct any mistakes on your credit report to maintain accuracy. Now here's a pop quiz. The first question is, which factor has the biggest impact on your credit score? Is it option A, credit mix, option B, new credit inquiries? Is it option C, credit utilization, or option D, payment history. The second question is, what is the ideal credit utilization ratio to maintain a good credit score? Is it option A, below 10%, option B, below 30%, option C, below 50%, or is it option D, above 50%? Please pause the video and take a few minutes to answer these questions. Once you think you have the answers, unpause the video and I will show you the solutions. Now let's take a look at the solutions. The answer to the first question was option D, payment history. The payment history has the highest weight in the credit score calculation, making up 35% of the total score. On-time payments can boost your score, while missed payments can lower it. The answer for question 2 was option B, below 30%. Keeping your credit utilization below 30% of your total credit limit can help maintain a strong credit score. A higher utilization can indicate financial risk and lower your score. Remember that credit is not just a number, it's a tool that can help lift people out of poverty and create opportunities. Let's take control of our financial futures and build a path towards stability and success. Thank you.